Hello and welcome to this video on the balance of payments. So in this video we're going to recap the components of the balance of payments and then look at some of the causes of imbalances in different countries' balance of payments accounts. So let's start off with our recap. What do we mean by the balance of payments? The balance of payments is a record of transactions between one country and the rest of the world. And we record these transactions into three accounts: the current account, the capital account, and the financial account. When we sum all of these accounts together, we should get a zero. The balance of payments should balance. Let's have a little bit more detail on those accounts. The one we talk about most commonly is the current account, and this is the balance of trade in imports and exports of goods and services. It also includes other income from abroad, so profits from investments abroad, and transfers, so money sent to other countries or money given, for example, to the EU. We then have the capital account, which is quite a small account, and this just measures the transactions of fixed assets moving in and out of a country. And then finally we have the financial account. These transactions are any FDI or any purchasing of stocks and shares. So how do we describe these different accounts? So for example, if we had a current account balance which was negative, it meant that the imports were greater than the exports, generally speaking, and we describe that account as being in deficit. If we had a capital account where assets coming into the country were greater in value than assets leaving the country without any change in ownership, we call that the capital account. The financial account, if we had net FDI coming into the country, we would say that account was in surplus. So we use the term surplus or deficit to describe the balances in these accounts, positive meaning surplus and negative meaning deficit. So does the balance of payments balance? Well, let's have a look at a hypothetical scenario. Let's imagine a very simple world with a country with no savings, no banks, and only the current account exists. Suppose we have a deficit on the current account, so we're paying out more money from the country than the value of money entering the country. Now, is this possible? Can I as a country pay out more than I receive? If I have no savings and I have no bank, no previous savings and no access to banks, then this isn't possible. So we can't run current account deficits in isolation. We need to broaden this a little bit further now to explain how we might fund this consumption if we can't fund it through savings, our own savings, or through banks. What would we need to do in order to have a current account deficit to spend more foreign currency than we receive? We would need to borrow from outside. Now that borrowing from outside will be a positive in the financial account, or perhaps we'd have to sell some of our assets to overseas investors, and again that will be a positive in our financial account. So we have a very simple assumption here with no savings and no banks. Often we see that to fund a current account deficit, we have a financial account surplus. So any movement in the current account must be balanced out by movements in the financial account and capital account. And because the capital account is quite small, we often just look at the financial account. So in answer to our question, does the balance of payments balance? Yes, in theory it should, although of course there are always some measurement issues. Here we have an image of the current account, collective current account balances over a number of years. So this is over a 28-year period, and what's happened in this chart is that the current account balances for each year have been added together. So if we have a country that has a very green colour, very dark green colour, that means they have amassed a combined current account surplus over those years, a positive value of nearly $2.7 trillion. If we have a very dark red country, what we can see from that is they have amassed over that long period of time, nearly 30 years, a huge current account deficit of nearly -$7 trillion. So we can have a look and identify certain countries that have big deficits, like USA, Southern Europe, the UK, And we can also identify countries that have big surpluses, namely China, Russia, Saudi Arabia, Germany, Japan. Two of the most obvious countries that stand out are the USA and China. The USA has accumulated a large current account deficit and currently runs a current account deficit, and China has accumulated a large current account surplus. What does this mean? Effectively that America import a lot more than they export, and vice versa for China, they export a lot more than they import. So we're going to be looking at some of these deficits and surpluses now and try and ascertain what might be the causes of this. So if you have a look at some of the countries who have current account deficits, here are 5 examples. So what might be some of the causes of a current account deficit within a country? Well, it might be the case that the country's products are not very competitive in terms of price, and so they don't export very much. Likewise, they might not be very competitive in terms of quality or other non-price factors, so it's hard for them to export and they import instead. Maybe for countries like the UK and the USA in particular, that there might be strong currencies with high purchasing power, which makes imports relatively cheap and so drives up a current account deficit. There may be external economic factors. For example, Brazil may see a slowdown in the economies of its trading partners, who then buy less exports from Brazil. Also, we tend to see a correlation between a lack of saving and investment and a current account deficit. Generally speaking, these countries don't have high rates of saving and investment into export capacity. So a little bit more detail on some causes of current account deficit. We've talked about price and non-price competitiveness. So you might want to take some of this down, maybe higher inflation or low levels of investment and research, maybe weaknesses in the businesses in terms of design, branding, performance. We've talked again about the strong exchange rate and the impact of spiced. Recession in one or more trading partners might cut the value of exports. And also global commodities prices being volatile often hit the exporters of primary commodities particularly. Now let's look at some countries that have current account surpluses. Here we have 7 countries that traditionally run current account surpluses, essentially telling us that they export more than they import. So what would be some reasons, some causes of current account surpluses? Well, often we see that countries with a high level of natural resources can benefit, particularly if these commodities have high world prices. So for Qatar with their oil, Norway with their gas, Saudi Arabia with their oil as well, they can export these natural resources, and if they have high prices, this might be the case. Strong businesses, so effective marketing, investment in research and development, these can have an impact. We particularly see Germany, a famous manufacturer of high quality products, Switzerland likewise, and then maybe an example like China, who specialize in manufactured goods, and they have businesses that are very flexible, adaptable, and are designed to export a lot. These countries tend to be characterized by high levels of saving, and if there's a lot of saving within a country, that gives a large amount of investment funds that can be deployed or invested into businesses to help them become more competitive. These countries often have huge export capacities, so they're often designed to service export markets rather than their own domestic customers. So for example, China, a lot of industries, a classic example of Chinese factories making American footballs, not because American football is popular in China, but because it allows them to export these products to the USA. And finally, a low exchange rate. Again, countries like China, although again, not all of these countries, a lot of them have strong exchange rates. For China, a low exchange rate might help them particularly compete on price, but certainly Germany would compete more on quality. Saudi Arabia, Qatar, it's much more about demand for natural resources. So we mentioned earlier about the balance of payments having to balance, and we've talked so far about the current account and in particular current account deficits. But we mentioned earlier that the current account does have to balance, and so if you have a current account deficit of $52 billion, it means that we're likely to have a financial account surplus of $52 billion to finance the current account deficit. So here, our buying more imports and exports in terms of goods and services maybe balanced out by money coming into the country and in terms of FDI or in terms of foreigners lending or investing money into our country. To illustrate the point, here we have the USA's current account balance in blue, and we can see their current account deficit over time, the 90s and then the noughties. And we can also see how this has been financed by surpluses on the capital and financial account. Again, there are some slight differences here due to measurement error, but on the whole we can see that financial account surpluses have funded current account deficits. So let's talk about these financial account imbalances now. What might be the causes of a surplus or a deficit on the financial account? Well, if we have a surplus on the financial account, one reason might be that the country as a recipient receives inward FDI. So the FDI in is greater than the FDI out. For example, foreign companies are building factories, plants, manufacturing equipment in that country, or foreign investors are buying shares in that country. This is causing money, foreign currency, to flow into our country. Secondly, they may be financed by borrowing from abroad, taking a loan from a foreign bank or foreign people depositing money in accounts in our country. This would cause a financial account surplus. Also, exchanging currencies, so people just moving currency, moving wealth between currencies. For example, hot money flows would be hot money flows coming into the country would be a source of financial account surplus. So the deficit really is the opposite. If we have a deficit on the financial account because we have a current account surplus, effectively that means money is leaving the country. So maybe we have a net outflow of FDI. We do more FDI abroad than people are doing within the country. So investing in overseas assets and shares. Maybe we're doing more lending abroad than borrowing from abroad. Maybe negative hot money flows. These would all be causes of financial account deficits. So in this video we've looked at the components of the balance of payments and then described some of the causes of imbalances of current account surplus and deficits, and also financial account surpluses and deficits, alongside some examples. That's it. Thanks very much for listening.